So you've calculated how much you need to retire early. That's good, but have you accounted for factors like inflation, taxation, the liquidity of your assets, and the necessity of building a financial reserve? Well, if you have, well done. And if you haven't, don't worry, you're not the only one. These are very common FIRE mistakes, and I'll explain how you can deal with those. First up, your FIRE number. This figure represents the wealth you need to accumulate to live off the returns it generates. Typically, it's calculated by taking your living expenses times 25. So that's your target. But what do you include in your wealth calculation? The notion of calculating your entire net worth and using that as your FIRE number is misleading for a number of reasons. It's best explained using an example with some numbers. Let's say your FIRE number is 25 times your current living expenses, which is 20k. That means your FIRE target is 500k. But let's say you've just paid off the last payment of your mortgage on your house worth 500k. Does that mean you're financially free and can retire? The answer is no, because the house by itself will not cover living expenses. Okay, that asset is illiquid and perhaps you might want to sell it, and let's assume you get exactly 500k in cash for it. So having 500k in cash surely means you've achieved FIRE, correct? Nope, that's wrong, because the 25 times the annual expenses formula is derived from the 4% rule, meaning it assumes an investment yield well in excess of 4%. If you recall one of my previous videos where we talk about where the 4% comes from, there the annual returns were based off the S&P 500, which averaged between 8 to 10% return per year. So even cash or interest savings account is not enough, because withdrawals will slowly deplete the portfolio. Instead, you need an investment which will return substantially more. Otherwise, you'll have to increase your FIRE number and invest in something less rewarding. So the mistake here is forgetting that the FIRE number formula is based off investment which appreciate like the S&P 500, as accessible as selling shares, that is part selling the asset and turning it into cash fairly quickly. This is also why you should be cautious about including pensions in your FIRE number. If you're relatively young, that pension will be inaccessible and could create shortfalls in your finances. If that's the case, you will have to factor that when calculating your FIRE number. So let's go back to the 500k FIRE number, and if you had 75% of that wealth tied into your pension, you would have to be careful if you retired early, say at 40 years of age. That's because you would need to fund 15 years of living purely from 125k of investments. If you withdraw 4% or 20k a year, you'd run out of money before you can access your pension. You actually have the wealth required on paper, but it's locked in your pensions. Therefore, part of a smart investment strategy should be to balance your contributions such that you're able to get the most out of your pension, but at the same time put aside enough to retire at the desired age. Another mistake people make when calculating their FIRE target is to ignore taxes. This can really put a dent in your plans for retiring early. So let's go back to our 500k FIRE number, which equates to a 20k withdrawal annually. Now, you're assuming that the 20k goes into your pocket, but you'd be wrong. You'd be paying tax on that amount. The amount of tax you actually pay depends on the source of income and in some cases your personal circumstances as well. In the UK, for the tax year 23-24, if the 20k came from selling stocks, of which 10k was capital gains, you pay zero tax. But if the same amount came from dividends, you'd pay around £560 of tax. And if instead your revenue source was classed as earnings, you could even pay over £2,200 in tax and possibly national insurance, which is almost 12% of your income. Therefore, don't neglect tax implication, especially if you're planning to retire early on a high income. Remember, your tax-shielded account and pension contributions might be your best friend here. The last mistake people often make when aiming for financial independence is neglecting to establish a financial reserve or a retirement emergency fund. This fund is much larger than your usual emergency fund and serves the broader purpose of carrying you through the years of recession so that you don't wreck your portfolio by withdrawing at the worst possible time. Check out this playlist, which will tell you everything you need to know about retirement emergency fund, what it is, why you need it, and how big should it be. And with that, I'll see you next time. Thank you for watching.